Welcome to Al Stock Trades. In this video, we are going to be learning about how to bake a cake. First, you want to preheat your oven to 425 degrees. I'm just kidding. We're going to be talking about dilutions and share dilutions, okay? So let's go back in time. Back in 1985, right, in the 80s, right, when people were sobering up from the 70s, okay? Well, this is the data from United Healthcare, and it's the shares outstanding. So as you can see, the investors in 1985, when they bought the stock, they were diluted to hell. United Healthcare diluted the crap out of them, right? So from 1985 to 1999, United Healthcare diluted, literally went from, I believe these numbers are in millions, around 200 million shares to almost, almost over a billion shares, close to literally at the peak around 1.5 billion shares, right? So they diluted them. Okay. So remember when Clover did the same and they went ahead and a lot of investors were like, Clover Health's management is terrible. Chamoth, scamoth. Ooh, good one, guys, right? Well, a lot of these investors came into the market quite young. They probably entered the market in 2020, right? Or possibly even by 2021. And they didn't understand, which is fine, you know? So they're on these message boards and that's their education and that's the extent of their education, right? But you guys are here for the truth. So what ends up happening is in the beginning stages of a company, they need cash. They need to dilute. And the reason why they dilute is because they need an ability to expand and grow. I mean, if we expect United Healthcare back in the 1985 to be what it is now, this dilution was necessary for its long-term success, okay? And we'll go ahead and pull up the stock price, okay? Because I got that one too, all right? So very clear. In the dot-com bubble crash, United Healthcare stopped diluting. They started buying back shares, right? From 1985 to 1999, they started buying back shares. So the shares went down, right? Oh my God, is that bad, guys? So pause the video. I want you to think to yourself, is this good or is this bad? The answer is, it's obviously terrible. No, I'm just joking. It's actually really good. When companies go ahead and buy back their shares, they obviously believe that it's a great placeholder of money. It adds value to the investors. But something quite interesting happened here on 2003. When you look at the inverted yield curves, or when you look at the 10-year minus the 2 or the 10-year minus the federal funds rate, you can see that it was trending down during this time. United Healthcare, as it was essentially, they predicted a recession. So they started to dilute shareholders even more, right? So they started essentially either selling their shares or making even more shares. I need to dwell deep into this, but it seems that more shares were unloaded. Most likely they were selling the shares because they believe it was, overvalued at this point because of the specific recession that was about to happen, right? And then the 2007, 2008 great financial crisis happened, and United Healthcare bought back a shit ton of their stock. Just look at that. They just bought so much. And since this day, they've been stable ever since. They haven't really done anything, right? It's been kind of boring, okay? But I wanted us to go from here. Now, the investors probably were like, what's going on here? Why did they dilute? Or why did they sell off more shares, okay? Well, I want us to go to Clover. So let's go back to December 17 of 2021. Okay. Clover said, we appreciate your patience on hearing from us during the quiet period, right? You remember when they had that quiet period where they couldn't talk about it in a month? So I guess November 17 was like hell for everybody, right? They raised $300 million. Well, let's go back. If we go here, and I'm going to read this really slowly. While timing the market is not something many consistently do well, we believe that waiting until next year to raise capital was too risky, given the possibility of a combination of potentially rising interest rates, which we are having, a potential recession, definitely close to that, and a contraction of investor liquidity, leading to a flight from technology-driven growth companies, which in turn would likely depress stock prices for rapidly growing technology companies. They predicted a recession. The painting was on the wall. And they diluted because they needed the cash to weather the storm. Guys, this is what a company needs to do. And for investors that basically got in and they don't have any investor experience, go pick up any of your most successful companies and see what happens. Now, during the 1985-1990, when United Healthcare was diluting the crap out of their investors, nothing was happening to the stock price. Nothing. Look at that. Nothing. But then look what happened now. It went literally from it was like pennies on the dollar. It was like $0. And look at it now. It's trading, it used to trade over 500. Now it's around like 450-ish. You see the power of dilutions. Now, I'm not saying you want to go out and buy any company with dilutions. Don't do that. They're called penny stocks. You got to be careful. But there's one key area that you need to couple it with. Let's say, are they growing? Are they about to become free cash flow positive? And they're all going to do that. Now, I expect them to be free cash flow positive and net income positive by 2024. They're saying 2023. Now, they could become positive by 2023, but I don't think they're going to be strongly positive. I think 2024 will be powerful. There's one key variable, though, that I did not add to the equation, that they got a strong CFO in August coming in, so I think that's going to really change it for them. But I want to go in and I want to talk about retail investors. I want to talk about you guys or your peers, right? Sadly, the black here is Clover, and the stock price has been hovering down. And would you look at that? You know, when I tell you retail investors are selling, dumb money is selling, smart money is buying. Sadly, look at the ownership of retail. Retail ownership has dwindled. Now, personally, now it has leveled down here at around a stock price near about $2.25. So that could be the new bottom. Who knows? But we're going to get to a point where Clover people are just going to be done selling. Now, sadly, you know, you might be asking yourself, who's selling? I'm not selling. Who's selling? Well, I mean, if you go to public.com, one of our members at our private Discord sent us a couple screenshots of people selling. And I was like, where did you find this? So this is public.com. You can find these people's names, but I didn't want to put them on YouTube and blast them. But you can see this person here invested in Clover about 408 days ago, so more than a year. They're down 72%. This particular person invested in Clover about 486 days ago, down 82.38%. 43 days ago, and he's down 13.36%. He's probably like, screw that, right? And then this person, 465 days, and he or she, I think this was she's down 74.41%. You know? So unfortunately, when I show you guys, if we go to our private Discord, and when we go up here and go to hedge fund information, and when we go to smart money and dumb money, and when I tell you that smart money is buying, right there, smart money, and while dumb money is at literally lows selling, sadly, and I hate to call these people dumb, but this is part of dumb money. Sadly, these are the solutions of retail investors of why Chamath Palihapitiya could say things like, well, retail investors are terrible at investing. It's true. It's true. So I wanted to point this out. I deleted it. I don't want to see that, right? I wanted to point this out, guys, because, you know, I don't want to be an a-hole, but, you know, there's reality, right? And there's a fake reality, right? This is reality, okay? Retail investors like to buy at the top, and they like to sell at the bottom, okay? It's just like the transfer of wealth, right? You know what I mean? They work hard for 4 or 5 years, you know, and then they lose it all. It's And then they go out and they say, oh, the stock market's gambling. So it's, be it as it may, it's a very terrible thing to see. And I hope that they learn their lesson in about 3 to 5 years. Okay, so we have a new price target revenue projection, but I want to make some assumptions here. And I'm going to make extreme conservative assumptions. Now, a particular company in the healthcare space recently bought out 4.2 times revenue multiple, 4 times revenue multiple. Let's assume Clover can match about 75% of that. Now, they already know it's a technology company, so it's going to probably go higher with the price to sales. But let's give it a price to sales of 3, okay? Right? I think that's fair, okay? And you know how they're currently growing at 300%? And if you actually take their growth rate for the past, since 2018, they're growing around 81%. And you know how I take 75% of that, which is 71%? I'm actually going to just do 30%. I think that's good. 30%, right? That's what I expect out of them for at least 6-7 more years, right? So let's go ahead and type in Clove. Okay. And if you look at the shares outstanding, it's 470.85, so about 470 million. Yes, I have these numbers memorized. And if you look at the 2022 projections here, well, it's obviously they're going to make around $3 billion. So when you do that, guys, look at how fast this calculation works. Boom! Look at that. So on average, if Clover is expected to grow until 2032, we could see a stock price hovering anywhere between $197 to $329 in 10 years from now. Okay. Now, I'm not saying that could happen. Okay. It's the projection. Now, personally, for me, what I would, hence why I told you guys, 2025, 2024, 2025, around the $40-ish region here. But personally, for me, what I like to do is I'm going to do 15%. Okay. I'm going to shrink this down. Okay. And I think a price to sales of 3 is sufficient. What I expect this company to pull in 10 years from now is anywhere between $58 to $96. So if we take the halfway point between 58 and 96, divide that by 2, I think $77, $75, $70 is going to be my price when I most likely will pull out. Okay? I expect this to happen when the next bull market run executes. And I believe the next bull market is going to be anywhere between 2025 to 2027. Now, I think the $75 price target is going to hit here, which, again, sadly, mania will come back. Crazy investors, speculators will come back, and they will drive up the stock price to most likely $75, which is a 2030 projection by 2026, 2027, which means that it's going to be 4 years ahead of schedule. Okay. Just like how investors drove up the stock price to around the base case here of $28 in a 2025 projection during 2022. Not even 2021, based off of these models. Now, you may ask yourself, hey, this is really good numbers. Why are you doing 15%? They're not growing at that rate. Well, I took United Healthcare's growth rate, which is around 15%. Now, if we go to our UNH here, and if you take a look at the financials and you look at the revenue here, you can see quarterly they're around 8.69, but on the year they're around 11.84. Interestingly, if we let's take a look at their income, their net income is around 12%. So I would say for a tech company, and again, it's on its early stages, meaning, we talked about United Healthcare, how it was able to just kind of skyrocket, right? But it took time. I think this tech company, it's fair to say 15% for the next 10 years, because in 10 years from now, I don't expect it to go 30%, 50%, 80%. I don't expect Clover to do that. There's not that many Americans in the world, in the United States, or, if the SaaS company does enter the Chinese markets, who knows? But there's a lot of regulation with that. And there's, it's a very sticky business. It's a very, not sticky like moat sticky. It's very like dangerous. So I'm not trying to be like, so what I'm trying to say here, guys, is that there's going to be investors about 4 or 5 years from now that are going to be buying this stock at like $80, $85, $90, and they're going to be pushing it up, and they're going to say, buy, you F-U-C-K, you buy, or whatever. They're just going to make fun of you, and they're probably going to come on this channel, and they're probably going to like harass the crap out of this channel, right? But the truth. If this, $75, 10-year price target, I would say, happens in 2026, 2027, overvalued. Now, if it's 2026 and 2027, and for some reason they're still growing 80%, then this is a big deal. We're talking big deal here, okay? Then you can go in and then you can put in the 30%, okay? I would say 30% is reasonable. And then we can say, about $250, right? But you have to understand, if this is $10 billion, then we're expecting them to make around $38 billion, $40 billion, I would say, in revenue, right? Let's call it $40 billion. If they're making that by 2026, 2027, then by golly, this is a big deal, because we're expecting them to make around $6 billion by 2025 to $8.5 billion by 2026 based off of these growth rates. These are slow growth rates. What I think is going to happen is, if they're going to continue growing fast and they're going to push their growth faster than what it's actually going to be in the future. This is a very crucial concept we're going to be teaching in the mastering course. So for all my mastering stock market students, please listen up. Growth companies tend to get all their growth up front and then they grow into their growth, right? Just look at Tesla, right? It's overshot, and now it's correcting into its actual growth. And it could overshoot again, but they got to develop that, robo-taxis, all these different things to make that revenue sustain higher, okay? So what I'm trying to tell you here is that if they are consistently growing 81%, and by 2025 they're at $17 billion, well, hey, we could see this $256 stock price, $150 stock price. We could see $125 stock price, but you have to understand, they're not going to be growing 81% year over year in 2030, 2031, 2032. So the market is going to correct itself, okay? That's why I'm doing 15%. Because I want to say, if I was to basically push this out 15%, what would it be? And I would say there's a hard stop at 100. Okay, there's a hard stop around that, right? We'll get more information when the time comes, because we are pushing 10 years out. That's a long time, okay? But we're going to continue sending off these satellite projections every single quarter. We're going to continue sending them out while analysts just focus on the 1 year. We're going to be focusing on that 10-year. We're going to keep sending them out. And the data we're going to be getting, we're going to have a better representation on what's a good price. And then we're going to, we can't forget about our intrinsic value calculator, especially once this becomes profitable. This one is going to be this is going to be this is going to be the godfather right here, okay? So I hope this made sense. There's a lot of information. If you want access to our intrinsic value calculation, our price to sales calculation, price to projected sales calculation for BrainMachine, you can find it in the link down below in the Mastering Stock Market course that has lifetime access. Prices will soon increase, so please take advantage. I will see you on the next one.